Okay, welcome. We have just started. This is the inaugural voyage of our little podcast here. We are focusing on insurance for estate purposes. You're going to hear a lot of talk a lot about things like needs and efficiencies, but for the purpose of today, we're talking about how high net worth individuals and business owners will use insurance for estate planning purposes. You will also notice that while there will be a little bit of product knowledge as these podcasts continue, it really is always going to be from an estate planning perspective, how insurance can be used within the context of estate planning, as opposed to the idea of throwing insurance up against the wall and seeing whether it sticks. So what we're trying to position ourselves as is that insurance fits. It's one of the various options. We're going to discuss some of those options, and we're going to discuss how business owners and high net worth individuals can use insurance for that purposes. On the panel, and I assume our regular panel, we have Jay Hershfield and Mark Goodfield, and I'm actually going to leave it to them. Jay, why don't you give a little 2 cents on who you are?
Yeah, thanks, Simon. I'm assuming everybody knows me from the internet, but just my little introduction is I'm a Jay Hershfield. I'm a tax lawyer by training. Practiced law for a few years in late 90s, early 2000s, including a stint at the Department of Finance in Ottawa in the tax policy branch, which is actually where I got my introduction to insurance. One of the files I handled for the Department of Finance was the life insurance files, and it gave me a very interesting perspective on trying to figure out, I'm sitting there, I didn't learn anything about life insurance and taxation of life insurance in law school or in my early years of practice. And I'm sitting in government and I'm going, hey, this is a product that grows tax-free, it pays out tax-free, it can be stripped out of a corporation tax-free. Why are we allowing this? Why is the government allowing this? And I really got a great perspective from a policy perspective, which I'm happy to go into, as to, why our government allows us to have this tool in our toolbox that we don't think about that often. No different than any other tool in our toolbox, whether it's RSPs or TFSAs or individual pension plans, just a tool that we can use to grow our wealth and distribute our wealth on a tax-free basis. So after getting such a great education, went back into practice, started using insurance a little bit with my clients. That eventually led to a role at Sun Life Financial as their director of advanced planning, which is a fancy word for professional handholder, where I helped Sun Life's largest clients implement insurance solutions in a tax efficient manner. And since Sun Life, I've been working with financial firms and independents, trying to implement insurance in the most tax efficient manner. Again, because from my perspective, although Simon, you mentioned needs before, although I value needs first and foremost, if not implemented correctly, you will not get the bang for your buck that the government intended by allowing us to use such a product so generously.
Yeah, so again, when we talk about needs and efficiencies, a lot of people will, in our world, come along and say, no, I have more than enough money, I don't need insurance. And that's true. That person will find a way to pay their tax bills, and they will find a way to put food on the table. That's not the issue. What we're going to be looking at from a theme perspective for this podcast is discussing how the tax efficiencies, these gifts, Jay, that you referred to, that were sort of laid down by finance and CRA, we're going to talk about how those efficiencies can basically not talk about, what do you make on your money, but how much do you keep? So exactly. We'll dive into that a little bit more. Up on the golf course, we have Mark Goodfield. Why don't you tell us a little bit about yourself? A very important part of this panel, just because we get that real life perspective on what actually is happening in estates and how they're divided, which we'll talk about shortly.
Yeah, so I'm a recently retired partner from a national accounting firm where I was working in the wealth advisory section with high net worth individuals and small business owners. Prior to joining the national firm, I was a tax partner and managing partner at a mid-sized accounting firm. And I am the author of the book, Let's Get Blunt About Your Financial Affairs. And I have a somewhat well-known blog that some of you may know called the Blunt Bean Counter.
Yes, a great resource for those that want to go and get some real talk on planning. Why don't we dive right in? Again, I think what we want to do is sort of go back to some of the basics, understand what actually happens in practicality, and then we can start looking at some of the sort of the pitfalls and where insurance can fit in. So, Mark, maybe you can start out in the most simplest form. You've been doing this for so many years. How do estates actually get split up? What's a typical scenario and a typical client?
So the reality is, at the end of the day, there's sort of three things that happen with an estate. Money gets paid to the CRA, money gets distributed to your family, or potentially also you use it for philanthropic needs. And so where my clients have used insurance in this sense is to pay the minimal amount to the CRA and try to give the most to your family and charities.
So Jay, again, Jay and I have been obviously on the insurance side for, combined probably close to 50 years. So we've almost seen it all. But again, very, very commonly what we come across is where the advisor has basically gone to the client and just said, you have this problem, you need insurance, which in fact is not true. What we go in to say is that insurance is an option. There are other ways to pay those estate liabilities. And Jay, maybe you can just go into what our clients' options are, because at the end of the day, all we're asking our clients to do is compare their various options and then decide on what's best for them.
Yeah. You know what, in an ideal world, I think the problem with estate liabilities is we don't have unlike the rest of our assets and throughout our lifetime. Normally we can time the sale of our assets to have the liquidity to pay our taxes. In fact, selling the asset itself might actually give you the liquidity to pay the taxes. When we pass away, we're deemed to dispose of our assets for fair market value 1 second before we die. And very few of us know when that's going to be. So timing is everything. It sounds like a joke, but there's a good day to die and there's a bad day to die. And from a tax perspective, and the simplest example is to look at equities, because valuing them is the easiest. To just go on the internet and just see what's my stock worth at this second. So as an example, if I have an equity portfolio, you actually want to die on the lowest day of the year from a market perspective, because you're deemed to dispose of those shares for fair market value, and you have a capital gain based on the difference between your adjusted cost base and your fair market value. So if I die on the lowest day of the year, that means my capital gain is going to be the smallest it could be that year, as opposed to dying on the highest day of the year where my capital gain is going to be the largest. So this year is actually a great example to talk about this. If I passed away in September of this year, assuming that I had no spouse and no one to get a rollover to with my assets, if I passed away in September this year, I'm deemed to dispose of all of my assets for fair market value. My tax bill is not due till the following April. So my estate's not going to have to pay my taxes till the following April. So this year in September, or pardon me, let's say this September or last September, let's say the market is at a high. And the following April, we have a 30% correction between September and April. So I'm deemed to dispose of my shares at, let's say, 100% value. But by the time my tax bill is due, those shares are only worth 70% of the value on the day that I die. Now, it's not that my kids don't have the money to pay the taxes. They can sell my taxes might have only been, effectively 25%. They still have 70% of that value. They have more than enough money to pay the taxes, but I don't want them, I mean, I'm dead, but theoretically, I don't want them paying those, selling my shares at a low value to pay a high tax based on a higher value. So in an ideal world, I have the liquidity to allow them to pay those taxes. So that's where people talk about insurance or saving cash, or just piling reserves. The one misconception out there is people often think, well, my estate will just borrow. And that's the most difficult part of the equation. So firstly, when you're talking about individuals, without incorporated businesses, estates can't borrow. I mean, in theory, there's nothing that stops them from borrowing, but practically, banks don't lend to estates because they want to see a clearance certificate from the CRA before they'll lend. And you can't get a clearance certificate from the CRA until you've paid your taxes. So it's very difficult for an estate to get a loan. And that would require beneficiaries, as an example, maybe to guarantee the loan. And often they're not in a position to do it or don't want to do it. So the estate does need some liquidity. Now, the alternative to insurance is just stockpiling cash yourselves and having relatively liquid assets yourself. So the question on that versus insurance really comes down, to the end of the day, internal rate of return. Where can I get a better bang for my buck? Saving for my taxes myself or having somebody else do it? And you'll find, depending on the individual, depending on the stage of life, the answers can differ. But generally, the return on insurance even in later years, 90 to 100 years old, if you're getting pre-tax equivalents of 7 or 8% at that point in time, it'd be very difficult to match that on a sinking fund yourself. Not impossible, but difficult.
So I just want to jump in here. Jay provided some sort of, let's call it a bit technical explanation. Simon and I, we've worked on a couple files where I'm going to talk a bit softer. Family harmony, which you would not think about when you're talking about insurance. Simon and I have been on several files where if insurance had been used, the family probably would have had a lot easier go of it when a parent passed away, because the parent had sort of thought something that didn't happen, or as Jay said, assets weren't as worth as much as they thought they would be, or certain children thought they're getting certain assets and they didn't get certain assets. So you can use insurance to sort of make sure everybody is happy in the family. And I know, Simon, you've had a few circumstances like that.
Yeah, I mean, listen, the unfortunate reality is, when you have a matriarch, patriarch, and now you're starting to deal with sort of next generation stuff, and you have, 3 siblings. One is the president of the company. One is a teacher. Another is, maybe a world traveler. They all have very, very different perspectives on what that estate represents to them. And sometimes it's that planning creates that family harmony to make sure that the cash is available when it's needed to appease all of the people. And the reason why, we raised at the very beginning that this is not about product, because product can't solve that. It's the estate planning discussion. What does it look like? Where do you want to get to? How are we going to get there? What products are we going to use to get there? But the product is really only the end game. It's about creating and helping clients understand that we want to create that family harmony and create that succession as easily as possible.
It's a good point, Simon. I'm actually, and thanks, Mark, for that too, because it's really about our clients, and I think this is the advisor's job with the clients is to force a little conversation about knowing your children and really understanding, trying to figure out what their reaction to passing is going to be. And not to take this off the insurance topic, but Mark, in your field, you would have done over the years quite a few estate freezes, as an example. And for anyone who's listening who doesn't know what an estate freeze is you basically you freeze the value of your corporation at that present time and pass the growth on to your children, the growth of the shares on to your children, so that you don't pay those taxes on the growth shares. Your kids pay those taxes on the growth shares when they dispose of them. And one of the big problems with estate freezes I find over the years was a lack of dialogue on behalf of the clients, because if, for example, when you pass away, you have a holding company and you did a freeze and the growth shares went to the kids. If the kids are not going to want to manage money together and not be involved together, and the day after you pass, wind up the company and go their separate ways, then they basically just undid your freeze that you paid a lot of money for to implement and put a lot of thought into. It's no different with an estate example that you guys are talking about. If your kids have very different goals and very different concerns, and now they're going to be arguing about things and going in different directions, as you suggest, insurance is not as much about liquidity or return. It's actually a little bit about buying time to allow these things to be sorted out, instead of getting people kind of going like that. And so to me, it's always just a little bit about knowing your kids, understanding your family, to deciding, where do I rank these things in order of importance.
It's really interesting you bring that up, because I've actually written a couple articles for different publications on vertical and horizontal relationships in families. So horizontal is the parents to the children and understanding the relationship, and vertical is actually understanding, or as best you can, understanding your relationships amongst your children, and how they're going to get along, once you pass away, or you and your spouse pass away. And it's not always necessarily easy to see that, but if you don't have rose-colored glasses, you sometimes can see that there is friction amongst certain of your children, and you really got to consider their relationships. And again, just Simon and I were working on something where the siblings really, there's some fractures in the family, and as soon as one of the parents died, those fractures became very apparent, and it got very messy. So we're sort of going a little off the technical side, but I think it's really important, this sort of soft side of understanding relationships amongst your family.
Yeah, so I think where we're going, which we could deep dive into this, and is actually a subject that I really, really like, because it really is the foundation of any discussion we have with our clients, is ideally you want to get to that place where you've got the business owner, the matriarch, patriarch, the family in a perfect world having a meaningful discussion about what happens, as opposed to waiting until someone in the family who basically is almost the custodian of all the important information knows everything and no one else knows anything. And this person has worked their whole life to build up the estate, only to leave a negative legacy, which is that the kids are now fighting, or the CRA is taking way more than they otherwise should. The discussion really should be, what do you want to happen? The most common, and it's always a very interesting one, I'll just use it briefly because it's really just a metaphor for almost any other scenario that we deal with, which is in Ontario very common, is the cottage issue, where families in Ontario bought cottages decades ago for this tiny amount. Now they're worth these obscene amounts. Parents die, the cottage is deemed to be disposed. Now 3 kids own that cottage and no one has a clue. How are the bills paid? What is that capital gain? We may need to pay $200,000, $300,000, $400,000, $500,000 just to keep the cottage in the family. But meanwhile, one kid lives in Vancouver, one kid is at the cottage all the time, one kid has the financial wherewithal and another kid doesn't. What do you do? And I suppose the upshot of this conversation is that the more we can have our clients discussing what do we want to happen in the future before it happens, the more we can maintain that family harmony and not leave a legacy of kids actually now hating each other.
It's funny, going back to your cottage example. I've had examples where, exactly as you said, the parents didn't really talk about the cottage. They just assumed everybody always loved coming up, so everybody loved the cottage. And then when they actually did speak, they realized that one of the children didn't even really want the cottage. They were just coming up because it was a family,
Right.
compound, and they felt that was a family obligation, but they really had no desire to own the cottage, and the parents were sort of shocked. So it all comes back to as much communication and discussion you can have with your family beforehand. It's the best.
So now you can imagine if that same kid, mom and dad have both passed, and now we have a $100,000 tax bill for each kid. If you want to, or the estate owes $300,000, they got to figure out a way to come up with that money. And then that one kid who never really liked going up there anyway, not only does he not want to pay, he wants his liquidity out of it. He also doesn't want to pay when the roof needs to be redone for $30,000 and pay his share. So it really is about discussion. I think there's been more and more studies that have said, talking about how businesses fail generation to generation because of a lack of discussion.
It's so I use a term I always tell clients, it's my job to be efficient, it's their job to be practical. And I say that but it's not entirely true, because it's also our job to be practical. And what I mean by that is ultimately, as advisors, and especially on this side, we're talking about tax a lot of the time. We're trying to be efficient. And the clients have to give us their practical concerns, but it's our job to ask those questions. And Simon, you do a particularly good job at this, as just generally part of your process is just asking a lot of questions and creating dialogue to be able to figure out what some of those practical concerns are. Do we need to have an agreement in writing to allow these kids to figure out how they're going to exit the cottage? If someone does exercise that they want out of the cottage, where's the money going to come from? Does it have to come up front in one lump sum? Like these are maybe more practical concerns that a lot of advisors don't involve themselves in on a day-to-day basis, because we're just trying to be efficient again, and we push the practicalities over to the client. But our clients don't even, for the most part, don't know the right discussion to have. And I think, Simon, give us an example of how you would lead a discussion like that.
Oh, geez, that's it. You're almost trapping me.
Well, I've seen you do it, so
You've seen me do it. Maybe ask more questions. Like, give me a scenario.
So, as an example, most people, a cottage example is probably such a perfect example, because cottages have such an emotional attachment versus almost any other asset that you have. And so you mentioned just now, a client assumes that their children, since they all come out, would all want the cottage. It's a family legacy. It's staying in the family. They may or may not have prepared for some liquidity to deal with the taxes when the cottage passes from one generation to the next. But they've never really, come into the detail of what this really looks like with in-laws and grandkids and everybody else taking over a cottage. So when you're talking to clients, directly about a cottage, would you start off by asking them questions about the cottage? Would you start asking questions about the kids? Are you talking about spousal relationships with the kids? Because some of that can get a little uncomfortable.
Yeah, I mean, and all of the above. I think it's those types of things, and we're gonna sort of, I'm not getting out of the question per se, but we're gonna sort of spring over to some other needs from an estate planning perspective. But yeah, it is about really understanding what's on the agenda, what's on that scorecard. I mean, ultimately what we're trying to do is create a scorecard so that if at the end of the process, we've actually checked all the boxes. And that scorecard is going to include the needs at those individual levels. It's going to include, and it's going to be some pretty tough conversations, but better to be having those discussions earlier on than after someone has died and now you have no choice and you actually have a clock ticking as to when you have to make those decisions by. So, there are other, the cottage is a great example only because it's so personal to so many people. The cottage, it's this asset which has huge value, which also has huge emotional quotient for certain people, and then for other people within the family it doesn't. So we've created a family dynamic that I think a lot of people hadn't really thought through. And that's really just a metaphor for some other things that also have some very emotional components to it, which, maybe you guys can discuss, or Mark, you can start with, where we might use insurance or estate planning, where again, it's between different parties and we need to sort of qualify and quantify and even document what some of those things might be.
Yeah. So from my experience, it really, in that type of situation, it really is business partnerships and corporations where you have different parties, and the shareholder agreement will have some kind of buy-sell agreement, and you are using insurance to fund the buyout of the deceased party's family. One of the things that is, I don't want to get into the details right now on this, but one of the benefits of insurance, especially in corporations, is that the insurance flows to something called the capital dividend account that can be paid out tax-free. And a lot, I've seen these agreements talk about the fact that there is a buyout, but the lawyer may not have experience in this, and they don't reference that the actual payment will be coming out of the capital dividend account. And in most cases, it's not overly relevant because the partners have a loyalty and respect to each other's. But I've seen situations where, the relationships between the business partners or corporate partners were not the best. And the shareholders want to keep the tax-free part for themselves and pay out a taxable dividend to the remaining family. So it's important to, A, consider the shareholder buyout, and B, make sure it's properly legally documented.
Yeah, so I want to go back to this briefly, back to this needs and efficiencies, and then we can, Jay, maybe you can talk about a couple other reasons to use permanent insurance, which I'll go into in a moment. So, Jay talks about, and has, since I've known him, talked about needs and efficiencies. So in the various examples that we've used, none of these people need insurance per se in its purest form. The person that was selling that stock after they died, that was going to the next generation, they absolutely could liquidate it, even though it's undervalued, or you're having a fire sale on it, or you could sell that piece of property. And so they don't need insurance in the traditional sense. They have the cash. The partnership scenario, maybe the surviving partner could take a loan. Maybe they have assets in the corporation. It's not a function of needing insurance, or maybe the most popular would be, a young couple with young kids. In the event that one of the parents died, there needs to be a replacement of income for several years. That's what we're going to call a need. So when we shift over to efficiencies, we're talking about exactly the things that you guys are talking about. So things like taking advantage of the capital dividend account, taking advantage of paying for, as Jay said earlier, you can pay for it corporately, it can grow in the corporation tax-free, it can get paid to the corporation tax-free, and it can flow out of the corporation tax-free. Yet the point still remains that it is just a tool. Liquidating the asset is a tool. Taking a loan is a tool. Insurance is a tool. It's a function of having the estate discussion as in terms of what it is you want to happen. It's a function of then looking at your various options and just basically comparing risk reward of all three of those.
And Simon, at the end of the day, whether you're talking about insurance or a sinking fund or whatever you're talking about to fund these issues. So the first thing you have to identify, as you just said, is it important to the client to deal with these issues at all, right? Or not? And there's no right answer to that. You're not obligated to leave a lot of money to your children, right? And everybody feels a little differently about that. So the first thing is identifying what's important to the client. To the extent that some of these issues are important, insurance versus any other asset really comes down to rate of return. And our tax rules are really what makes that return work. I mean, our government, allows the insurance company, they collect our premiums, they don't pay tax, they grow the insurance, it doesn't, there's no tax, it pays out there's no tax. There's a mechanism, as Mark suggested, through the capital dividend account to strip out a good portion of that money without paying tax. The lack of paying tax inherently increases the return of the insurance, which makes it difficult for other financial instruments to match on any type of reasonably guaranteed basis. So once we've identified the issues for the client and decided whether or not these issues are important to the client or not, the conversation around insurance really comes down to rate of return. And I always say insurance has a negative rate of return. Your best deal is to get hit by a bus on the day that you bought it. And your worst deal is to live 5, 10, 15, 20 years past your life expectancy. But even if we go into a client's, into their hundreds, specifically or particularly in corporate situations, the idea that we can get this money out without paying any tax, and it's not just always as simple as here's the insurance, comes out, there's no tax. There's other moving pieces, which is why you need your professionals. But in theory, getting this money out without tax, getting this lump sum out without tax would generally mean that you would need to close to double that amount just to get it out of the company on the same net basis. So, I always, going back to that insurance conversation, sometimes and most people talk about insurance like it's a product. I don't, for most of our clients, I don't see insurance as a product. I see insurance as a set of rules. The government has given us some very generous rules that allow insurance to grow tax-free, pay out tax-free, get stripped out of corporation tax-free. No different than RRSPs or TFSAs or RESPs. I think people should be educated and understand how those tax rules work. Do they work for them? Ignore product. Do they work for them? If those rules work for them and it makes sense to somebody to be able to, provide their estate with cash in this tax-free manner, then the conversation starts to become, well, what's the best way to do it? What's the best product to do it? Different products have different, different growths, different costs, different tax consequences. So it's a separate conversation. But when you get down to the product conversation, the hardest part of this whole analysis is generally people who have money in these situations and can afford this type of insurance. Generally, they're not young. From time to time, we run into very successful 35-year-olds who are already talking about their estate planning. Most of these conversations are being had with people in their 50s and 60s and 70s, and sometimes even 80s. And insurance will still work not only from a pricing standpoint, but also particularly from a tax standpoint. The problem is the older people get, they're more likely starting to have some health issues, and the insurance cost might go up over time. And I think that's the big crux of this conversation. If insurance was free, it would work for everybody. The answer is, of course, it's not free. So pricing is what inherently creates that internal rate of return. And being able to get clients insurance on a standard basis is probably going to end up being the yes or no to whether or not this type of strategy works.
Right. So we'll talk about that and underwriting and some of those pitfalls and some of the ways we get around those pitfalls to maximize, again, of course, the lower the cost base, the lower the premium, the higher the rate of return. And that's, of course, always going to be our goal. So we'll talk about that in a future podcast. Maybe in closing, we can just sort of almost do a little bit of a free-for-all between you two guys, just in terms of where, again, we're talking about permanent insurance. We're talking about, we're not going to get deeply into product, but we're talking about permanent insurance that will actually not expire in your lifetime because it's intended to pay out benefits when you die, whether it's, God forbid, young or whether you live to a ripe old age, north of 100. But maybe between the two of you guys, just start rhyming off where you see people nowadays, business owners and high net worth, using insurance for this, what we're going to call efficiencies.
So I'll just briefly get back to almost the cottage. So cottage is a legacy asset, but there's more than cottages that families consider legacy assets. A lot of families will have we'll call it real estate empires, where to the parents, the certain buildings or land are really emotionally attached to. It was the first thing they bought, or they really think it's going to grow. And so they really, even though they could just, their children could sell these buildings or whatever, this other legacy asset or their business, if the children could sell the business, sell the buildings, and you have no need for insurance because you have more than enough cash to cover it off. The parents want to keep these assets in the family. And also, you know, as Jay had said, sometimes it's not the best time to sell an asset when someone passes away. You want to sell it when it's the, you know, higher market, or where it makes sense. So I've seen a lot of insurance taken to cover off the tax liability of these legacy assets, so that the children then can maintain these assets, especially where there's this family emotional attachment, or if there is no emotional attachment, sell those assets at a time in the future that makes better economic sense.
Yeah, and for real estate, you know, that's a great market to look at, especially in Toronto. You know, right now, and obviously all three of us are kind of in the GTA region. And when you're looking at, you know, Greater Toronto, we'll take that geographically, it's pretty far. You know, we have clients who have real estate all over the place, and this real estate has gone up in value significantly. They've held it for a long time. They become very attached. They don't want to sell it. They want it to stay in the family from one generation to the next. And in fact, every time they have any extra money, what they've always done is just bought more real estate and invested in more real estate. So although they recognize the problem, they recognize there's a tax problem, they can't or don't want to fund that problem, because they've always done better from a return perspective by putting it back into real estate, something they know, something they're very comfortable with. So what they can't create a sinking fund, they can't buy life insurance because they want to take every penny and put it back into real estate. And so a very popular discussion point with these clients is buying the insurance to be able to take care of the tax liability, and either immediately or sometime down the road, having the insurance as an asset that they can borrow against. So for the next time they want to invest back in real estate, they still have that asset that's available to them. They didn't give the money up for insurance, because they can put the money in insurance and borrow it back out to go put back where they otherwise would have put it. And if they're putting it back into their business, putting it back into real estate, that's an investment. And if they're using the insurance as collateral, they have the ability to write off the interest. And that can often allow a lot of these families to accomplish two goals at once. And we're seeing a lot more of that, I think, as people recognize they do have a tax liability. And at the same time, they really aren't comfortable selling assets now or in the future to fund that liability.
And in a future podcast, we're going to talk a little bit about, it sounds great. It sounds sexy. It sounds like, well, I'm not losing anything. This is great. But it really is critical that it's implemented properly with the right assumptions, so that you're not looking at this thing 20, 30 years from now when your advisor is no longer in the business and you go, what did we do? Why did we do it? And why isn't it working anymore? So it's really very critical to approach these things properly. Insurance is elegant. It is simple, believe it or not. And CRA gave us, and finance gave us, some tremendous tax efficient gifts that we don't want to abuse. We don't need to make it look sexier than it already is. It already works. And I think that's sort of a critical point. Any other areas you guys want to talk about? Yeah,
sure. So I think also equalization. So I briefly mentioned when we're talking about legacy assets, family businesses, and real estate, but let's just take the family business. So let's say, for argument's sake, you have 3 children, and one of them is in the business and the other 2 have no interest in the business. And it's been determined that in the will, the one child who's in the business is going to be given that business. So the family may not have enough assets to sort of equalize with the other 2 children. So they can use insurance as an equalizer for that business, if that's something they want to do.
Yeah, no, I always like that one. That's very, very common with our clients, especially where one of the kids is a professional and wants the biz and the other clearly doesn't, or that applies to properties, it applies to all kinds of things. For the purpose of this podcast, I think what we sort of summarized, what we're talking about here is efficiencies versus needs. It's how we can use insurance as a tool to help families create harmony, keep the assets that you work so hard for. From a process perspective, and where we all in our own worlds, whether it's as a tax lawyer or an accountant or an insurance guy or whatever, wealth advisor, our job is to first sort of help open up that discussion where we can actually identify the problem. Where I want to get to with a lot of our clients, and I know you guys are the same, whether you've done all the work, you've done the freeze, you've done this, you've done that, and you've estimated out that the number is, we have a $30 million tax bill that's going to be due. It's a fact. We want to get to that place. We want everyone's head to be nodding. Yes, we have got to that place where we know the facts. We know it's not growing anymore. We've done a freeze. We know the future growth is going on to the next generation. But the reality is we've established the fact. The question now becomes, what are we going to do about it? And that ranges in all the things that Mark and Jay talked about, whether it's liquidity or loans or so on and so forth. And insurance is, because of its tax efficient nature, is a worthy competitor to anything else because of its preferred tax treatment. So all we're suggesting is start the discussion, quantify and qualify what the need or the want or the efficiency is you want, and then throw insurance into the mix to compare how it performs against any other options that you may have. But it is all about keep it simple. If you're starting to push beyond the boundaries of your comfort, then go the other direction. This is something that we want to, as Jay said to me probably 20 years ago, insurance is the no risk portion of your portfolio. So don't add risk to a no risk product. That means considering interest rates these days. It means considering legislation changes. It means considering everything that might add risk to this otherwise elegant no risk product.
So Simon, on a personal level, so I thank you for crediting me for that statement, but I still live by it. And pardon me?
Who did you steal it from?
I didn't steal that.
It was yours. It was Jay.
Yeah, but that I'm a conservative by nature. I'm not a risky guy, but personally, and I say personally, I mean people who are owning insurance policies on a personal basis. You can do, just by understanding the client, just by understanding the product, you can do on a 100% risk-free with guaranteed returns. That's wonderful. When you get into the corporate side, as much as the agent understands the product and as much as the agent understands the client's needs, and like anything else, anytime you're involving a corporation, there are tax considerations that one has to consider. And, I'm not sure if we can deal with this now or in future podcasts, but one of the big deals to me is, I find a lot of our clients are not getting the right tax advice from their lawyers and their accountants, particularly because their lawyers and accountants are not specialists in the field. They're not necessarily tax specialists, as an example. And when we're dealing with corporate insurance, although we're satisfying liquidity needs, we're getting a good internal rate of returns, it is important for our clients to have the right tax advice to make sure that the policy is being set up correctly. Because there are tax consequences of having policies in the wrong corporation and having to move them, because I had them in my operating company and now my operating company is being sold and I got to take my policy out. What did we think of that in advance? Or is there a tax consequence to moving it? Is there cash value in the product? And cash value is, I describe, for those who don't know, I describe cash value as of any insurance policy. Cash value is what the insurance company will give you to go away. It's yours. It's what you can actually get in your lifetime. It's what you can take. It's what you can leverage. When we talk about leverage, banks don't lend against the death benefit of the insurance policy. They lend against the cash value of the insurance policy. The reason they don't lend against death benefit is because they're not allowed to kill you, meaning that money's not real until you die, and banks don't, if you default on your loan, banks don't want to wait 10, 20, 30, 40 years to get their payment. They want to get it now so they can access the cash value, because that's what's real. That's what the insurance company will give you. Well, that cash value, as valuable as it is for leverage, as valuable as it might be for the client if they want their money down the road, it can cause negative tax consequences if not dealt with properly in the corporation, which is where you need tax advice. So for anybody who's considering, corporate insurance, personal insurance, like you said, Simon, it really is just a risk-free way to fund certain liabilities and just look at it from an internal rate of return perspective. The second we're involving a corporation, it will do the exact same thing, but you have to make sure that you're doing it the right way. And that's where the advice comes in.
Yeah, good point. So a great segue. I'm going to save that because we're starting to now talk about some of the pitfalls and some of the things that we're going to be looking out for. So I'm actually going to leave it here, guys. In our next podcast, we're going to talk more about pitfalls and some of the things that we really want to look out for, some of the hard questions we want to ask. I think that, to your point, maybe the planning, some of the planning out there is not optimal. They haven't asked some of the sort of very important questions to make sure that it's been structured properly. So we'll talk about some of those things to look out for to make sure that it's done properly. And I think we're going to leave it at that. But Mark and Jay, thanks for your input. Great discussion, and I look forward to our next one.
Thanks.
Thanks, Simon.
All right. Bye, guys.